Hi, everyone. Welcome to today's episode of College Financial Prep's Preparing for College podcast. So excited, such an important topic we're going to discuss today with Donna Cates. We're going to be discussing saving money on the cost of college. And I know that this is a big topic. You always hear it from me. But let me explain the difference right now of what we're going to be discussing today. So I help people save money on the cost of college. But what happens, once the child is born? Where should you be saving up your money? So that's what we're going to be discussing today. Let's welcome Donna. Hi, Donna.
Hello there. Thanks for having me today.
You're very, very welcome. Can you tell people a little bit about yourself, your background, and what you do?
Absolutely. I am a financial advisor, a certified divorce financial advisor, and also a divorce financial mediator. So those are all my professional hats, but I've been doing this work for about 23 years and am grateful to be able to share some knowledge about this college savings stuff.
So important. So many, and I get the question a lot. And the first thing I say is, I am not an investment person. I could say, yeah, 529 plans are great, but that's the extent of it. So I'm glad that you're here today to talk to everybody about the different options and what's available to everyone to help with savings. I mean, I've even been saying the past few days, and I'm serious, it's so important to save. I don't even care if people stick money under a mattress. Is that ideal? Of course not. That's why Donna's here.
Sure. And something's better than nothing. That's always the case. And the other thing is you can't start soon enough. Most of us start later, but the sooner you start, the better.
Definitely, definitely. So let's dive in. You shared with me that there are 6 different ways, ideal ways, to save up money for college. So do you want to start? So what are those ways? What should we be considering? What's the best way in your opinion?
I will tell you unequivocally, the best way is using the college savings program, the 529 account. Every state in the U.S. has a plan, and you don't have to purchase one from your specific plan, but there might be tax advantages to it. But if it's okay, what I'd like to do is just tell you some of the pros of using a 529 account versus some of the cons associated with it.
Definitely.
Okay, so with the 529 accounts, this is money that is literally set aside specifically for the benefit of your child. So it's got to be somebody that is a relative, not, a friend. So if I, as a mother, decide to open up a 529 account for my child, I'm the owner of the account, but the child is the beneficiary of the account. And the biggest advantage to it is that when I start investing that money, anything that comes out of that account to pay specifically for college related expenses is tax-free at the federal level and could even be tax-free at the state level, depending on your state and the plan that you're invested in. So this is huge. And a recent tax law change now allows us to also use some of that 529 money up to $10,000 per year for K through 12 tuition. So that's a new twist. So I wouldn't recommend doing that unless you know that you've got enough saved for college, but it is something that's available for you. The benefit
definitely for those parents where the kids are going to private school, certainly.
Absolutely. And see, and you can double save too. This is something that a lot of people don't know, at least in the state of Alabama. So it's a question to ask in your state. We get a tax deduction in Alabama for making a contribution into a 529 account. So I literally could say, I'm paying my private tuition today for my child, but I'm going to deposit $12,000 into this 529 today. And I'm going to turn around and pull it out in 5 days. Absolutely okay. You didn't make any money, you didn't grow any assets, but you do get that tax deduction for that current tax year. So that's something to consider if you're using the money now. Now, one of the drawbacks—
that can apply also even not just for K through 12, also for college students. If college students want to, parents of college students want to do that, Keep that in mind if you're, either paying it off up front, one lump sum, or payment plans, however you're doing it.
Absolutely. So knowing your state tax laws is going to be a crucial thing for you too. So another one of the big pros of the 529 account is the amount that you can save is typically more than most of us are going to need. You could actually put up to 500,000 into an account, depending on the plan. And you as an individual can actually gift up to $16,000 per person into a 529. So if there's a mom and a dad or a couple.
That's 16,000 per year?
Per year. And that's actually, that qualifies for the annual gift tax exclusion, I should say. So I think from your perspective, Vicki, the big deal is that this money is owned by the parent and it is treated as a parent's asset. So
Definitely.
There's nothing to be reported for FAFSA.
Well, that's not true. So, wait. So it is a parent asset. So for FAFSA purposes, it's reported as a parent asset, which is much better than if it was to be reported as the child's asset.
Got it. Thank you for that clarification. You're absolutely right. Now, let's shift to some of the cons of a 529. The biggest one is—
Wait, can we go back to some pros? Because I can think of some pros.
Yeah, you go ahead and share your take.
Say a family has money in their child's 529 account and the child doesn't need all of the funds. Maybe they go to they got lots of scholarships, they didn't use up all the money. It can then be put into a sibling's account or a cousin's account, is my understanding.
Absolutely. So you can literally change beneficiaries at any time. And I had a client, this was a perfect example. She had her oldest daughter went to a local university. So it was state, college tuition. And she only used maybe a third of her 529 savings. But then her younger daughter was going to a very expensive design school. So she was easily able, after she knew that her oldest daughter had used up what she needed, she just actually rolled that money over into her other daughter's 529. And another thing to that is this. Right now, based on the tax code, there's no rule that says that you have to use it by a particular age. So let's say I go to undergraduate on full scholarship and I have a 529, that's okay. It's still going to be sitting there and invested for me to use 3 years, 5 years, 15 years from now. So that's always there to use. There's no limit on the age at which you can start using or use up those funds.
Right, it could be used for graduate school. I believe there was a new law recently passed that money left over can even be put towards a Roth IRA, a retirement account now, right?
That is correct. It would have to go into a Roth to keep it in that tax-free benefit.
Right. Mm-hmm. Now, to me, that's a huge benefit as opposed to having to take out the money and then being, whatever tax penalties. So I think it's fabulous that they're allowing that now.
You're absolutely right. And you just mentioned the one thing is the biggest penalty. That's if you have money in a 529 account and you pull it out and don't use it for the benefit of the child's college expenses. And when we talk college expenses, we're talking room and board, tuition, the stuff.
Not a new car.
Right, not a new car or paying for groceries. That's right. So it's got to be
No. Wait. Paying for groceries. And I only know this from my own son and doing my own little research. As a student, if you were going to be paying a meal plan or, cooking for yourself, buying groceries, that can be covered by the 529.
You just taught me something I did not know. Thank you. Okay, awesome. Shared wisdom.
Also, living off campus. So it has to be up to what the dorm would cost.
Got it.
So as long as it's a student, it can go towards those types of living expenses. But you can't say that, my child's going to be 100 miles away from home and therefore needs a new car. that doesn't fly.
Got it, got it. So the penalty, if you did decide to use that money for something other than the college-related expenses, is hefty. It's 10%. Just like when we take money out of a retirement account before age 59, there's a 10% penalty. Same thing here with a college savings account. And then the other negative thing is that all of that money that you've grown on a tax-free basis is now taxable at your ordinary income tax. So you as the parent or the grandparent are the owner of the account. So when it's liquidated, if it's not used for its intended purpose, now you get the 10% penalty as well as having to pay your full ordinary income tax rate towards that growth. So that's definitely a negative. I will tell you that the only potential shortfall of the 529s, other than the tax penalty if you don't use it the intended way, is that sometimes the investment options can be a little limited. They're definitely in mutual funds. There are a variety of funds available. So finding something that would suit you is not the issue, but it's kind of like us investing in a 401k. We can only invest in the funds that the company has selected for us. So it's got to be in that particular fund family's, bucket. So
Right.
but that's it. So.
And I guess it's subject to the ups and downs of the market. It's not a guaranteed type growth product, right?
That is absolutely right. We will talk about one that's guaranteed, but there's only one option out of the 6 that is. Okay. So I truly believe that 529s are the best option for anybody. And don't forget too, that anybody can contribute to those. So I literally, when I have a friend that's having a child, I gift them money and start a 529 account for them. And that's then I coach them on how they need to ask their relatives to do, especially the babies, because they don't need a whole lot of stuff. Even though we have a tendency to buy them all the stuff, put that money in the 529 and buy them one thing, right? So that's my perspective anyway. But let's move on.
I love that idea.
Yeah, well, and number 2 is the custodial accounts, or what's known as the UGMA or UTMA, Uniform Gifts to Minor or Uniform Trust for Minors account. Now, these are great because you as the parent can use this money for anything that you want to. But the thing is that when you invest that money in this type of account, when the child reaches the age of majority, which is different depending on the state that you're in, might be 18, it might be 21. But when they reach that age, that money is now legally theirs. So initially, you're the custodian of the account, but when the child reaches the age of majority, it can transfer directly into their name and they can choose to use it however they want. That type of account gives you a lot of flexibility in how you invest the money, because here you could say, I just want to put it in individual bonds, or I want to buy Disney stock, or whatever. You can invest it in anything that you want to. But the biggest benefit is you can spend it on anything. So in an ideal world, if you had plenty of money to save, you would have a 529 account specifically for the college and the tax-free benefits. Then you would have a second account that would be the UTMA, where you could save for things like purchasing the future car or the future wedding expenses and such. So, and another benefit is that the income up to $2,000 per year on that UTMA or UGMA account is actually taxed at the kiddie tax rate. And then it goes up to your tax rate if it's more than $2,000 a year in dividends and interest. So that's it. Now, to me, you're the expert on how this affects FAFSA. So that, because it is the child's asset, would impact FAFSA. Is that right?
Yeah. Yeah, 529 is better.
Yeah, right. Okay, that's what I thought. So FAFSA is going to count that as a child's asset. So that could be a potential negative. But that would be the second option to the 529. Then we have what's called the Coverdell educational savings account. It used to be called the Education IRA, and that changed in 2002. This one, it works similar to a 529 account in that it's intended to be used specifically for qualified education. The drawback to this account, and it is tax-free, just like the 529, but the drawback to this is you can only fund it with $2,000 per year. So if you're limited in assets, you can contribute that amount. That's, again, it's better than nothing, and it would be probably better than putting it under the mattress like we joked about earlier, simply because you can invest it and potentially get some growth. And let me say this about the investment perspective too, is, like Vicki said at the beginning, none of this is guaranteed. There is one strategy that gives you some guaranteed income, but when you're investing it, you need to be cognizant of the risk that you're taking in those investments. So if you have a newborn and that child is obviously not going to go to school at least for another 17 years unless they're a brainiac, but that money, you've got time to be more aggressive with the investment. But ideally, you would want to start off aggressively, and as the child gets closer to using the funds, start getting a little bit more conservative with it. And the 529 accounts, most of them have what's called the age-based portfolio, where you don't have to make the decisions of when to start scaling back on the aggressiveness. They'll actually model that for you and make those adjustments. Now, a con for the Coverdell education account, we already talked about the $2,000 per beneficiary per year maximum. The other is that they only have until age 30 to use the money. So you have to make sure that the contributions are made before age 18, and then the money has to be used by the age of 30. So unlike the 529 that can just go on and be handed down to somebody else, that's a deal breaker in the college of the Coverdell.
So do you ever see somebody use both 529 and Coverdell?
Yes, I will tell you that you've got to have the discretionary cash flow to be able to fund them, but especially I see it mostly with grandparents. So it's typically, they may have more assets that they're not going to be relying on to live off of. So they've got a little bit more discretionary cash flow than the young moms and dads that aren't at their peak earning years or what have you. But oftentimes the grandparents will create as many accounts as they can to maximize that savings for the grandkids.
Fabulous.
Okay, let's talk about mutual funds. Now, mutual funds is, again, this is a way that you could just say, hey, I'm going to open up a traditional brokerage account. I'm just going to sock money away. You could do, $50 a month, $100, $300, $500, whatever you want. There's no minimum or no maximum on what you can fund, how much you can put into a mutual fund account. But this would actually be in your name. So you would be the owner of the account as the parent. You can invest it any way that you want to, but every year you're going to have, you're going to get that 1099 like we're getting in the mail right now to tell you what your dividends and interest were that were earned and paid out over the year. Doesn't matter if you take those dividends and interest or if they're just reinvested, we still have to pay taxes on that as the money is growing. So you're not getting the tax break that you would with either the Coverdell or the 529 accounts. Now, the other drawback is that when you do sell something, let's say, you've been saving money for the last 15 years. Now it's time for Johnny to start going to school and you have to liquidate. Now you have the 15% capital gains tax. Unless you earn over $440,000 per year as a couple, your capital gains tax is 15%. More than that income, it increases to 20%. So you've got the annual paying taxes on the dividends and interest. And then at the time that you liquidate the assets to cover the expenses, now you probably have capital gains tax. So those are two of the drawbacks to doing it in a mutual fund account versus the 529 account. Okay. All right, now let's talk about the one that is the kind of guaranteed. If you have confidence in the U.S. government, the qualified U.S. savings bonds. So it is literally the safest investment that there is. So it's a debt security from the government, issued by the Department of Treasury. And since it's assured by the U.S. government, they're seen as a very low risk investment. The unfortunate thing is, because we've been in such a low interest rate environment, the interest earnings that you're going to get are going to be dismal. Right now, where interest rates are starting, they've gone up a little bit because of inflation. So you might get a little bit better return than you typically would. But these savings bonds are federally tax deferred and state tax free. So you're not going to be paying taxes. Let's see, I've got to look at my notes here about let's see here. Oh, that's what I was looking for, is the cons. You're only allowed to purchase up to $10,000 per year in savings bonds. So that
and how many years do you normally need to leave it in savings bonds before you could use it?
That's a very good question. And that's where I'm going to be candid and tell you, I don't know the specific amount of time, but it's typically like a 7 to 10 year maturity. And that's an estimate right there. But that's why that has to be something that you start very young. And then, when the child's born, if you plan to use it by college age.
Right.
But that's a good point, because you got to buy it and hold it until it matures and then cash it in and that's when you get the interest. Very good point.
Yeah, no,
okay.
I was thinking it was even longer. I was wondering, how it works when, the child is going to school at 17 or 18.
Right. And I need to circle back with you on that. I want to know the real answer to it. Because I think you can buy different maturities, but I'm not 100% on that. It's not something that we use typically, at least in my world. And you're buying it obviously not through a brokerage firm or an investment firm. You're buying it from the Treasury Department. So
right.
Now let's talk about the last option, and it's the Roth IRA. So a Roth IRA, if you're not aware, is where we as individuals take after-tax income, money that we've already earned and paid taxes on, we contribute to the Roth IRA account. And because we've used after-tax income, we don't pay taxes on the growth or any of that money that was contributed into it ever. So that's what makes the Roth IRA an attractive investment vehicle, if you don't make too much money and can actually fund it. So first, you got to be able to, have the income level that would allow you to do that. But the great thing is that with the Roth IRA, we can pull money out of that Roth IRA without the 10% penalty for pulling it out before age 59 and a half. You don't get the 10% penalty when the funds are used for higher education, for qualified higher education. The other benefit is that you literally can invest it in anything. And because it's a retirement account, it's not considered by FAFSA. So
it's not considered by FAFSA. However, be aware that certain schools require the CSS profile. It is considered, retirement accounts are considered on the CSS profile. It's a list of about 300-400 schools. So in general, no, you don't have to worry about retirement accounts, but these select schools that use the CSS profile, they want to know everything.
Wow. They're not going to miss a dime, it sounds like.
No, not at all.
Well, and there's basically I think there's two concerns or cons with using the Roth. The first one is that, again, there's a maximum in how much you can contribute to the Roth each year. The amounts went up for 2023. So now if you're under 50 years old, you can do $6,500 per year. If you are older than 50 or older, you can actually do $7,500. So that just went up $500, for each category. The drawback too, though, is that most of us aren't saving enough for retirement. And since we're putting that money in specifically for retirement, that's what we should be intending its use for, not to pay for college. But it would be a kind of in my book, it would be a last resort place to pull from if you didn't have adequate savings elsewhere.
Yeah, let me say this, as we're talking about retirement accounts, one thing that always concerns me when working with parents is that, the potential need for student loans to help pay for the college education. And it's not just the students paying back the student loans, but the parents, the students can't take out loans to cover, $80,000 a year of college. So sometimes the parents need to take out student loans as well. And the parents will be paying, could be potentially be paying their children's student loans. They may even still have their own student loans from when they went to college. So all of this is going to impede being able to retire or save enough for retirement. So it's all related, and hopefully everyone in the household will work together to make good decisions to hopefully save money and be able to move forward and retire successfully.
Absolutely. And that's, I think, one of the benefits of doing really in-depth financial planning is you can see what the impact would be on everybody at every stage of life. So to do that and know that, yes, this makes the most sense, because the reality is that, children and parents can get loans for school, but nobody's going to let us borrow money for retirement, right?
That's true. But okay, so you can take out the loans for college. Students, freshman year, they can only take out $5,500 in student loans. So who has to take care of the balance? It's typically the parents. Yes, the parents can take out student loans to help pay for college, but are they doing so at the detriment of their retirement funding? So it's all to me, it's all part of the same issue.
Absolutely. And Vicki, there's one other thing I just thought to bring up, and this is, 50% of marriages are ending in divorce. And if you find yourself in that circumstance, one of the things that you might consider if you are divorcing is, how are the two of you going to work together to fund the savings for the 529s and such? I have clients who actually, now the divorce, the law, the divorce court is not going to say you have to do this, but they elected to say that, the income ratio for this particular couple was he earned 70%, she earned 30%. So we actually calculated what we anticipated the college costs to be and what they would need to be saving per month for each child. And then whatever that payment was, we decided, is this a reasonable amount for you to both contribute in total? And once we decided what they could afford to contribute, then we said, okay, he's going to make a 70% contribution each month, and she's going to make the 30% contribution. Now, this particular couple, they elected just to have one 529 account for each child, but I have seen couples say, I'm going to have my 529 and she's going to have her 529. But if you go that route, just make sure that you're prepared to communicate with one another, to let each other know what you're doing, so that there's we know how to plan together for our children's financial future.
Yeah, when it comes to paying the bills for divorced couples, it's important to obviously know what the total amount due is, and then you're each paying your agreed upon share. So if you have the two separate 529 accounts, I think that's a clean way to do it, or whatever savings vehicle each is using. But also, you don't need to pay the bill together. It's possible for one parent to take a student loan and another one to pay their share entirely. It can be done separately, and it doesn't matter, who fills out the financial aid applications. Both parents can pay the bill, can take out separate student loans, can do what they need to cover the bill and take care of their child.
Perfect.
So thanks so much. I think that this was wonderful information, helpful information, a lot of information.
Yeah, absolutely.
So glad that you were able to share it all with us today. Donna,
Thank you.
where can everybody find you?
You can find me at moneymatterswealth.com.
Fabulous. Thank you, Donna. And thank you, everybody, for joining us today on Preparing for College.
Thank you.
Bye.